Hello. In today's video, we're going to continue a discussion we had recently on the subjects of risk management, trader psychology, following rules, and so forth, which really are, if you put all of that stuff together, that is more important than trade signals. And it's something that you really want to revisit a number of times because it's really easy to lose focus on some of those rules and managing risk and so forth. So probably the best person, or one of the best people, I should say, to learn a lot about market speculation, investing, and so forth is Jesse Livermore. For those, which was probably many, know the history of Jesse Livermore, his success as a trader. For those that do not, have never heard the name before, just a really brief introduction. He was a trader in the early 1900s, very, very successful, and probably the top trader in his time. Estimates based on current value of money put his net worth at times of, north of $10 billion. But everything was not roses for Jesse Livermore all the time. He also, not only did he make a lot of money, he also gave a lot of that wealth back. So I think I'm not sure he was bankrupt or not, but he was as close to it as you possibly can be. And then the other end of the spectrum, very, very super wealthy. So I think through all of that, there's a lot of rules that he developed, and thankfully, I'm thankful myself that he has shared those, because even though they go back to over 100 years ago, they're still very valid. So with that set, and in no set order, let's take a look at some of his top 10 trading rules. Do not trade every day of the year. It's really common for people to want to trade constantly. And the point that he's making here is you need to be patient. You need to wait for the market to present itself in accordance with how you trade. And every day is not going to be an opportunity to trade. So you want to be patient and don't try to force trades. Rule number 2, trade only when the market is clearly bullish or bearish. For most people, this is valid. You don't want to be trading when markets are sideways, or you can call it like a period of consolidation. For some traders that like to fade moves, for example, then they want to trade in markets that aren't necessarily bullish or bearish. But for all intents and purposes, for most of us, if you're an active trader, you want to be trading when the market trend is clear. You really do not want to be trading during a period of like consolidation, where maybe there was a big move up and then price needs to consolidate, and traders are trying to understand if price is going to continue to move up or if it's going to start to move down. Rule number 3: continue with trades that show you a profit and trades that show a loss. A lot of times early on in a trade, you're going to know if your theory was right, if you should have entered that trade or not. If you entered that trade and you go into a profit right away, then you want to let that profit run. You want to manage your risk to some extent, and you should know that before the trade goes on. But the contrary, if you put a trade on and you instantly go into a loss, don't start moving stops to allow you to stay in that trade. Reevaluate. Maybe there was something that you thought was the case, which was wrong, or you read something wrong. Get out of that trade, accept defeat, be in a position to play again the next day. Rule number 4 is kind of similar to rule number 3 in terms of a loss. Never average losses by buying more as a stock falls. A lot of times what people want to do is they put a trade on, it goes against them, and then all of a sudden, like, they're shocked that they get the chance to buy at this even lower price. Or they feel if they buy at this lower price, now the stock doesn't have to go all the way up for them to actually start to make money. They're kind of averaging down. Don't ever do that. You're essentially, if you initially put a position on and it starts to go against you, something's wrong. That's the last thing you want to be doing, is adding to that position. Rule number 5: don't become an involuntary investor by holding on to losses. Again, kind of similar to 3 and 4. If you're going to do a quick trade and all of a sudden you put a position on and the stock goes against you, don't all of a sudden tell yourself what was going to be maybe a 1 or 2 week trade is now going to be a long-term hold for the next 10 years of your life. That's the worst thing that you can do. You made a mistake. Accept the fact that you made a mistake. No one's perfect in this business. It's impossible to be perfect. So you just accept that mistake and exit and move on to the next trade. Number 6, no trading rules will deliver profit 100% of the time. That is so valid, yet so many traders, once they have a bad trade, they feel like there's something inherently wrong with them. It's possible you need to reevaluate your approach, your strategy, and so forth. But even the perfect traders, or the best traders, I should say, are not perfect. There's nothing as a 100% guarantee in this business. A lot of times, a lot of successful traders have uh, looked at 40%, maybe 50% win rates. So, take it from them that you're not going to be successful 100% of the time. Losses is part of this business. Rule number 7, never buy a stock because it has a big decline from its prior high. That's another thing. Somebody misses a move, a stock rips higher, they miss that move, all of a sudden it kind of comes back down maybe 10% from its prior high. And they look at that as, wow, this thing can't pull back anymore. This is a great buy. They put the position on and they start dreaming of the profit they're going to make. It's odds are it's not going to happen. Before you put a position on, you need to make sure that that move is, because you're going to go counter trend. So if a stock's pulling back, you don't want to just catch a falling knife, as people like to say. You want to make sure that move down has ended and there's a period of consolidation has happened, and then that stock can move higher. So be patient. Rule number 8, the human side is the greatest enemy of the average investor. It's quite ironic in this business that it can be a very cutthroat. Sadly, people can be pretty nasty in this business. But this business also, success requires that you have this deep understanding of who you are as a person, your emotions, and so forth. It takes a lot of soul searching to be successful in this business. You have to combat that enemy inside, which is going to fight you the most. Rule number 9, big movements take time to develop. Time to develop, excuse me. A stock doesn't just rip higher out of nowhere. It can, maybe on earnings or a short squeeze or something, but big moves always take some time. And essentially, you need to get that big base of good buyers in there, people that can hold on for a while. So you don't, a lot of times people feel like if a stock moves higher that they miss the move and they chase it. Give it time, let it come back. Almost always it's going to come back to you. So be patient once again. And the last one, and again, there's more than 10, but I just picked these I thought were kind of the more important ones. Pattern, and this one I think is the most important. Patterns repeat because human nature has not changed. A stock, and I'll do a video on this another time. Stock charts are really just speaking to the psychology of traders. That's all they really are. They're not price action. They're actually talking about trader psychology. And trader psychology is never going to change, partly because this business, people come in, they invest their money, and they don't follow their rules. They lose their money. A new set of people come in. And a lot of people come in looking for a quick, get quick rich type of scheme. And that's not the case in this business. So patterns are always going to repeat. Periods of euphoria where stocks just rip higher and they just keep going and going and going because people bid those stocks higher. That stuff's always going to happen. It's never going to change, which is actually probably one of the beautiful things about this business. It allows you to start to model future price action to some extent. So those are some of the top rules. As always, make sure you're managing your risk. It's super important. I appreciate you listening, and happy trading. Thank you.